Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. I don't know about you, but when I see a company that has a long track record of growing its dividend and that dividend yield is over 5%, it catches my attention. And that's certainly the case with 3M right now. Here's the thing. 3M stock has fallen pretty sharply over the past year. The dividend has hardly grown that much, and there are some really big risks with the company right now. So if 3M is the dividend stock that you're really looking at right now, that could be a huge mistake. We're going to talk about that here on The Smattering. I'm Jason Hall. I've got Tyler Crow here with me to talk about it. Hey, Tyler.
How's it going, Jason? It's a company that just kind of gets attention, and you see some social media chatter on it. So I thought it was time we hashed this one out.
Let's talk about what's going on. So long term, 3M has become this really interesting business, and it has some appealing aspects to it because it provides some things that we know of as consumers, right? The 3M brand, we think of the tape and other products, the industrial products that we buy, but it sells a tremendous amount of the things that it makes to manufacturers and to industrial companies that use as inputs for their devices, or they use the products inside their facilities. So we think about it as this big stable business, but let's talk about what's going on that creates, I guess there's like 1A and 1B of two things that are one thing that are a substantial amount of risk to the company right now.
Yeah. So for the longest time, 3M made its hay as we're going to, do a lot of R&D spending. That R&D is going to translate into new products. And as those new products scale in volume, we're going to basically capture margin growth as those products scale. And this is where things have kind of gone weird for 3M for the past several years. When volume isn't able to maintain itself, and you're kind of only stuck with trying to do price increases on commodity products. I mean, let's face it, one of its signature things is Scotch, tape, Post-it notes. You can't pass on huge price increases on products like this to make your margins, right?
Right. Well, you're supposed to make your money on the other end. It's not the pricing power of what you sell it for. It's the cost advantages at scale of what it costs you to make it, right?
Right. So let's back it up 5 years, right? To 2018, the operating margin for this company, somewhere in the 18% range. Today, that operating margin has declined to about 13%. So over a 5-year period, because of this inability for these new products to really catch on and scale, we've seen a rapid deterioration in its margins. So you're already starting to see a little bit of a decline on the profitability side, on the financial side. Already not great, right? And we're starting to see it in kind of sclerotic growth for net income, sclerotic growth for its dividend, passing on more or less, like call them like token dividend raises to keep its dividend streak going, right? Because it wants to say that we grow its dividend annually.
Stay on all of those lists of dividend growth stocks.
Exactly. So you already have this kind of stagnating business, right? On top of that, you have these two huge liabilities kind of hanging over it right now. In the case of two court cases, you have one related
potential liabilities. Let's
potential
be clear on that.
liabilities. One is related to there is a class action lawsuit against some earplugs that it sold to the U.S. military. The class action lawsuit says they were defective, caused ear damage. There have been some cases so far where 3M has tried to claim bankruptcy at the subsidiary level to isolate itself, and so far the appeals courts and everything has said no, it's part of your business. You're liable for it. And in addition to the earplugs one, there's also one related to what are called perfluoroalkylate substances, also known as PFASs. This is kind of a hot button issue because they're known as forever chemicals, and there's several class action lawsuits related to cleanup mitigation of these forever chemicals. Now, certain estimates, if you want to ask some people over at like Bloomberg Law, they're saying these could be tens of billion-dollar potential lawsuits here. So if we're evaluating the downside risk in this company, we have a company that's not growing great right now and potentially could be on the hook for tens of billions of dollars in legal liabilities. And things don't look as attractive when you start looking at things like that. It makes, even though you're seeing this high yield investment, could be attractive. Somebody wanting income right now might be attracted to it. But if that situation were to play out, all of a sudden that dividend probably isn't going to be there anymore. And so I think investors should really take pause before doing this, because there are a lot more risks involved.
So to kind of summarize everything we're looking at with 3M right now, I think here's the key thing when I say buying 3M right now could be a mistake. If you're going into 3M looking to capture that high yield and you're counting on that dividend and you're counting on the dividend to be able to grow or even just be able to be supported, that's where this could be a mistake. If you're thinking about this more as a risk reward opportunity as an investor and you're going into it eyes wide open with the fact that the market is compensating right now for some of those potential risks, and that's why it's trading for this price, but the outcomes could be a lot worse than the expectations right now and you could lose money, that's a different situation as an investor if you're taking on that risk. The mistake is not acknowledging that risk and going in this to it without considering the potential outcomes.